Did you know that over 70% of real estate investments fail to deliver the returns people expect, leaving many homeowners worse off than if they had invested elsewhere? Owning property might seem like a sure path to wealth, but in reality, it can trap you in high costs, unpredictable markets, and declining values. If you're considering buying real estate to build your future, you need to hear this warning now. This video will reveal why owning property could actually be one of the worst investments you make in 2025, and how to avoid the costly mistakes that trap so many. If you want to protect your money and make smarter financial decisions, make sure to stay tuned. Don't forget to like and subscribe for more insights. Now, let me show you why this is so urgent and what you need to know before getting started. Today, we're exploring why owning real estate might be a bad investment in 2025. Despite the common belief that property is a safe path to wealth, the reality is quite different. Over 70% of real estate investments fail to deliver the expected returns, often leaving investors worse off than they started. This is especially true in today's economic climate, where rising interest rates, market volatility, and declining property values are creating significant risks. Understanding these challenges is crucial for anyone considering real estate as an investment, whether you're a beginner just starting out or someone with some experience looking to protect your hard-earned money. This video will explain why buying property might no longer be the best move in 2025 and will guide you through smarter alternatives to grow your wealth. By the end, you'll know the key reasons why real estate could be a trap this year and what strategies can help you avoid costly mistakes. You'll walk away with a clearer picture of the current market pitfalls and how to navigate them smartly. But to make smart decisions, you first need to understand the economic landscape we're dealing with. In 2025, the landscape of real estate investing has shifted dramatically, and the environment is more challenging than ever. According to the Federal Reserve, interest rates have risen steadily over the past year, reaching levels not seen since the early 2000s. Higher borrowing costs mean that financing property purchases is more expensive, reducing profit margins for investors. Meanwhile, the Bureau of Labor Statistics reports that inflation remains stubbornly high at around 3.5%, eroding purchasing power and increasing the cost of maintenance, property taxes, and other expenses associated with real estate ownership. The combination of rising interest rates and inflation creates a perfect storm. Higher rates discourage borrowing, while inflation pushes up the prices of building materials and services, making it even more costly to maintain or develop properties. Additionally, housing prices have begun to decline in many markets, signaling a potential downturn. The Fred database shows that nationwide home values have dropped approximately 5% since their peak in 2022, and experts warn this trend could continue as economic uncertainty persists. Taxes also play a significant role. Increased property taxes in many states, coupled with the potential for rising capital gains taxes, further reduce the net returns on real estate investments. Coupled with market volatility and the cyclical nature of real estate, these factors make owning property in 2025 a risky endeavor for many. With this context in mind, let's break down the strategy you can actually apply. Owning real estate has traditionally been seen as a smart way to build wealth, but in 2025, the landscape has changed. The main strategy now is to carefully evaluate whether buying property is still a good investment or if it might actually be risky. When you invest in real estate, you usually buy a property hoping that its value will go up over time. Many people also use leverage, which means borrowing money to buy a property, thinking that the property's appreciation will help them pay off the loan and make a profit. However, with high interest rates and rising costs like taxes and maintenance, this strategy becomes more complicated. Key terms to understand are cash flow, which is the money left after expenses, and equity, the part of the property you truly own. As costs rise and property values fall, your cash flow might turn negative, meaning you spend more than you earn. Meanwhile, decreasing equity reduces your financial cushion and can make selling or refinancing difficult. Given the current market conditions, higher borrowing costs, inflation, and falling property values, owning real estate might not be the safe, profitable move it once was. Instead, it's important to explore other options that offer more stability and less risk. Now, let's look at a real-world example to see exactly how this plays out in practice. Imagine you find a charming 3-bedroom home in a suburban neighborhood listed at $350,000. You decide to buy it using a 30-year fixed mortgage with a 6.5% interest rate, which is realistic given current market conditions. Your down payment is 20%, so $70,000, leaving a mortgage of $280,000. Monthly principal and interest payments amount to about $1,776, according to mortgagecalculator.org. Now, add estimated property taxes of $4,200 annually, or $350 per month, and homeowners insurance of around $1,200 annually, or $100 per month. Your total monthly housing cost comes to roughly $2,226. Next, consider rental income. Similar properties in the area are renting for about $2,200 per month. That sounds promising, but let's factor in other costs. Maintenance, property management, vacancy rates, and unexpected repairs typically add up to around 10% of annual rent, about $2,640 per year, or $220 per month. So your net monthly cash flow looks like this: $2,200 income minus $2,226 costs minus $220 expenses, resulting in a negative cash flow of approximately $246 each month. Over a year, that's nearly $3,000 out of pocket, not including potential property value depreciation or market fluctuations. Given the current market cooling, with property values down around 5% since 2022, this investment could further lose value, and your cash flow might not cover costs. This looks great, but only if you avoid the common traps that ruin deals like this. Owning real estate in 2025 can seem like a solid investment, but there are critical mistakes that can derail your success if you're not careful. First, many buyers overlook the importance of thorough due diligence. For example, rushing into a purchase without inspecting the property or analyzing the local market can lead to unexpected costs and poor returns. Second, overpaying is a common trap. In a volatile market with rising interest rates, paying above market value can quickly turn your investment into a money pit, especially if property values decline. Third, ignoring the full costs involved, such as property taxes, insurance, and maintenance, can catch you off guard and eat into your profits. Many investors focus only on the mortgage payment, but these hidden expenses add up fast. Fourth, poor credit management can increase your borrowing costs, making financing more expensive and reducing your cash flow. And finally, neglecting the potential risks of market decline, like the 5% value drop since 2022, can leave you stuck with an asset that's losing value instead of building wealth. To avoid these mistakes, it's essential to do your homework, set realistic budgets, and understand all associated costs. Proper planning and due diligence can help you navigate the current market challenges, turning potential pitfalls into opportunities for smarter investing. To avoid those mistakes, here are the best tools and resources available right now. Owning real estate in 2025 can be more challenging than ever, especially with high interest rates, inflation, and declining property values. To navigate this environment wisely, you need the right tools. First, use platforms like Zillow.com, to research current market trends, property prices, and neighborhood data. It helps you identify areas with better growth potential and avoid overpaying. Next, check your credit profile on Credit Karma, creditkarma.com, which provides free credit scores and advice on improving your financial health, crucial when applying for loans or refinancing. For detailed investment analysis, Investopedia, Investopedia.com, offers comprehensive guides and calculators that help you understand the true costs of property ownership, including taxes, insurance, and maintenance. If you're considering rental income, use Rentometer.com to compare local rental prices and ensure your expectations align with the market. Lastly, for legal and contractual guidance, Rocket Lawyer, RocketLawyer.com, provides accessible legal documents and advice to protect your investments. With these tools, you can make more informed decisions, avoid common pitfalls, and develop a realistic view of what owning property entails today. Now that you've got the tools, let's talk about the first thing you can do today to get started. Today, I want to encourage you to take a small but meaningful step toward understanding your financial health. The task is simple. Download a free credit monitoring app like Credit Karma and check your credit score. It might seem minor, but this step unlocks valuable insight into your borrowing power and helps you identify areas for improvement. Knowing your credit status is the foundation for making informed decisions about future investments, loans, or even deciding whether now is the right time to buy property. By taking this initial action, you create momentum. You start to see your financial picture clearly, which motivates you to explore other essential steps, like listing your monthly expenses, simulating what a property investment might really cost, or even just tracking your spending. These small actions build confidence and clarity, turning uncertainty into manageable steps. Remember, every successful long-term plan begins with a single, realistic move. Taking that first step today sets the stage for consistent progress. When you stay committed to these small actions, they compound over time into meaningful change. So let's start now. Download that app, check your credit, and see where you stand. This is how every long-term success story begins. Stay consistent, stay curious, and watch how small steps today lead to bigger opportunities tomorrow. Imagine looking ahead 30 years from now. What if instead of just owning one property, you committed to a steady, consistent approach? Over time, with patience and discipline, those small investments add up. Perhaps by 2035, you could own 5 cash-flowing properties, each generating steady income and appreciating in value. The power of compound growth means that the rent increases, property values, and consistent savings all work together to build wealth. It's not about quick wins or risky shortcuts. It's about showing up every day, making smart decisions, and trusting the process. Even with the ups and downs of the market in 2025, a long-term mindset transforms uncertainty into opportunity. Small steps taken consistently, researching properties, monitoring your credit, saving diligently, are what ultimately create momentum. Real estate, when approached with patience, can become a powerful vehicle for financial stability and growth. And now that you see what's possible, here's how we wrap this up and take action. Start today by setting clear goals, educating yourself, and establishing habits that support your long-term vision. Your future self will thank you for the consistency you invest now. Investing in real estate in 2025 isn't always the surefire when it used to be, especially with rising interest rates, inflation, and fluctuating property values. The key takeaway? Careful research, patience, and a long-term mindset are essential to turn property into a solid asset. Remember, leveraging online tools like Zillow, Credit Karma, and Rentometer, along with maintaining your credit score, can help you make smarter decisions and avoid costly mistakes. Even amid today's challenges, consistent effort, like saving regularly and educating yourself, can build wealth over time. Building multiple income-generating properties is possible, but requires discipline and strategic planning. So, stay focused, set clear goals, and keep learning. Thanks for watching and celebrating your progress toward financial stability. If you found this helpful, hit that like button, subscribe for more insights, and comment below. What's your first financial goal for this year? Want to dive deeper? Check out our video on smart real estate strategies for 2025. Remember, building wealth is a marathon, not a sprint. Stay confident, stay focused, and keep pushing forward. See you in the next one.